The building operated on precision. Glass corridors reflected controlled movement. Conversations were measured. Decisions were filtered before being spoken. No gesture went unnoticed, though most were never acknowledged. Authority did not announce itself here. It occupied space quietly and expected alignment without instruction. On the upper floor, behind reinforced walls and calibrated access panels, there was a door that did not respond to urgency. It responded only to time. The door was not decorative nor symbolic. It was functional, engineered to open at one specific interval each quarter. For 7 minutes. No override. No emergency access. No executive privilege. When the internal clock reached its assigned threshold, the locking mechanism disengaged with soft precision. When the interval closed, it sealed without hesitation. Inside that room were long-term allocations, structural commitments, capital that shaped markets without ever appearing in headlines. It was not a vault for currency. It was a vault for timing. Most employees in the building never saw the door. Those who did understood its significance, but not its mechanics. Only one individual held the authority to initiate review during the opening window. Not because of ownership, not because of seniority, but because of discipline. The hierarchy appeared balanced on paper. Titles were evenly distributed. Committees operated with democratic pretense. Performance reports circulated weekly. Yet imbalance existed in quieter dimensions. The majority responded to movement. The minority created it. On the surface level, analysts built projections. Executives approved direction. Advisors offered interpretations of volatility. But beneath that surface was a singular pattern: reaction. Markets shifted. They adjusted. External pressures intensified. They reorganized. Competitors expanded. They countered. Every strategic action in the building originated as a response to something that had already happened. Except for the decisions made behind the time-locked door. Those were never reactions. They were anticipations. The individual assigned to the door did not hold the highest public position. That omission was intentional. Visibility creates vulnerability. The role required insulation from applause and criticism alike. He occupied a modest office facing the interior courtyard. No skyline. No corner suite. His desk held no personal artifacts. Files were arranged in horizontal stacks, each labeled by quarter, not by client. Time governed everything in that room. Colleagues considered him methodical but unremarkable, reliable but not charismatic. He did not attend networking dinners. He declined panel appearances. He never volunteered opinions during large meetings unless asked directly. Even then, his responses were brief. This miscalculation sustained the imbalance. Because the building valued visible dominance. Those who spoke longest were considered influential. Those who negotiated aggressively were considered powerful. Metrics favored velocity over patience. But the door required neither volume nor speed. 3 months prior to each opening, he began preparation. Not through frantic review, but through subtraction. He eliminated noise from incoming reports, reduced projections to structural patterns, ignored emotional spikes in data, paid attention only to behaviors that repeated without announcement. He did not attempt to predict headlines. He analyzed silence between them. During quarterly executive sessions, debates intensified as the opening date approached. Proposals accumulated. Urgency disguised itself as insight. The building mistook movement for control. They presented investment expansions, geographic diversification, aggressive acquisitions, strategic partnerships that promised immediate growth. Each proposal was framed as necessary. Each carried subtle fear beneath its logic. The door remained closed. In private review sessions, he listened without interruption. He did not challenge assumptions publicly. He asked one question per proposal, rarely two. Questions that shifted focus from projected gain to structural stability, from visibility to sustainability, from excitement to endurance. Answers often exposed impatience. The imbalance deepened not because he opposed them, but because he refused to accelerate with them. 2 weeks before the scheduled opening, market volatility increased. External analysts forecasted contraction. Competitors announced rapid expansions to counter anticipated downturns. The building reacted accordingly. Emergency strategy meetings filled calendars. The upper management floor grew louder. He reduced his schedule. Assistants noticed the contrast, but did not comment. His calendar contained long, unmarked blocks labeled review. No explanation. No external participants. Inside those hours, he studied time rather than numbers. Historical cycles. Behavioral repetitions in executive overconfidence. The correlation between urgency and structural miscalculation. Patterns invisible to those inside daily operations. The door did not reward courage. It rewarded accuracy. 48 hours before opening, pressure intensified. The chief financial authority requested pre-approval summaries. Committee members pushed for preliminary commitments so execution could begin immediately after access. He declined. The refusal was not confrontational. It was procedural. Access decisions could not be pre-aligned. The building interpreted this as rigidity. Some interpreted it as obstruction. None understood that the door itself enforced neutrality. Once opened, it did not allow extended deliberation. 7 minutes demanded clarity that months of debate often failed to produce. On the morning of access, the atmosphere shifted from loud to compressed. Conversations lowered in volume. Movements became deliberate. Even those not directly involved sensed significance. He arrived at the secured corridor precisely 11 minutes before the interval. Not early, not late. 2 security personnel authenticated credentials. Biometric confirmation. Internal clock verification. No ceremonial acknowledgement followed. The hallway contained no observers. At the exact second indicated by the internal system, the locking mechanism disengaged. The sound was minimal but definitive. A subtle mechanical alignment. Inside the room, there were no piles of currency or dramatic displays of wealth. There were sealed digital terminals connected to long-term capital channels. Allocations that could influence supply chains, stabilize industries, or withdraw support silently. 7 minutes. He did not rush. First minute. Confirmation of structural baselines. Liquidity reserves. External exposure. Internal leverage ratios. Second minute. Rejection of all proposals influenced by recent volatility. Not out of caution, but because timing dictated separation from noise. Third minute. Reinforcement of positions that appeared stable but were quietly eroding due to overconfidence elsewhere in the market. Fourth minute. Withdrawal from a widely celebrated expansion initiative competitors had embraced weeks earlier. Fifth minute. Allocation toward sectors currently dismissed as stagnant. Sixth minute. Recalibration of reserve positioning, invisible to quarterly performance metrics. Seventh minute. System lock. When the interval concluded, the mechanism sealed without regard for unfinished thought. It did not accommodate hesitation. He exited the room without visible expression. By midday, executives received confirmation summaries. No dramatic announcement accompanied them. No celebratory communication. The allocations contradicted several internal expectations. Aggressive expansions were denied. Conservative positions were strengthened. Capital was withheld from high-visibility opportunities. Frustration surfaced discreetly, not openly. Reputation inside the building required composure. In subsequent weeks, external volatility intensified further. Competitors who had accelerated expansion faced liquidity strain. Headlines shifted from optimism to exposure. Overextended positions required emergency restructuring. Inside the building, stability persisted. Quarterly performance did not spike. It did not crash. It remained controlled. Executives began to recognize a pattern, though few articulated it. The door did not reward ambition. It neutralized excess. Yet imbalance remained. because authority over time creates quiet distance from those governed by immediacy. In private conversations, some questioned whether the model limited potential upside, whether excessive restraint sacrificed visible dominance, whether future growth required bolder execution. He did not defend the process. He simply prepared for the next interval. The building continued to operate on visible precision. Reports circulated. Committees debated. Markets fluctuated. Behind reinforced walls, the door waited. It would not open for another 3 months. And during that time, the imbalance would widen. 3 weeks after the last opening, stability began to look like hesitation. Performance reports remained steady. External volatility had punished competitors who expanded too quickly, validating the previous allocations. Yet validation created a new vulnerability: confidence in restraint itself. The building did not celebrate publicly, but internal tone shifted. Executives referenced the previous decision cycle with subtle pride. Risk committees cited disciplined capital positioning as proof of structural superiority. Analysts used phrases like controlled foresight in presentations. Restraint, once criticized as limitation, was now reframed as strategic vision. That reframing altered the atmosphere. Where tension had previously pressed against the time-locked door, now expectation accumulated around it. Stability attracts ambition. Quarterly meetings regained their earlier tempo, but the underlying motivation had changed. Instead of reacting to volatility, leaders began anticipating advantage. They saw opportunity in weakened competitors, market share vacuums, undervalued acquisitions. Public confidence tilted in their favor. External analysts praised the institution's conservatism during turbulence. Reputation strengthened. Invitations to participate in large-scale partnerships increased. Visibility grew. Visibility exerts pressure. The individual assigned to the door observed the shift without commentary. Reports that once carried urgency now carried optimism. Proposals arrived earlier in the quarter. Teams framed their strategies not as necessary defenses, but as logical expansions. The language softened. The intent hardened. Committees did not explicitly challenge the door's authority. Instead, they began designing strategies that required its cooperation. Large-scale projects structured around capital releases timed precisely with the next interval. External negotiations scheduled contingent upon internal approval. They did not confront the system. They built around it. This represented a more sophisticated imbalance. Previously, pressure manifested as open urgency. Now it emerged as integration. Strategic alignment designed to make refusal appear inefficient rather than cautious. He adjusted his preparation accordingly. Instead of focusing solely on market signals, he began analyzing internal tempo, frequency of proposal submissions, volume of optimistic forecasting, correlation between positive press coverage and increased capital demands. He recognized compression forming. Compression does not announce itself through crisis. It builds through consensus. 2 months before the next opening, a major acquisition opportunity surfaced. A regional infrastructure conglomerate weakened by overextension during the recent downturn. Competitors were circling cautiously. The valuation was attractive. Public narrative framed the acquisition as inevitable consolidation. The internal executive committee framed it as a defining move. Projections demonstrated long-term yield potential. Risk analysis showed manageable exposure under optimistic growth assumptions. External advisors signaled support. Crucially, negotiations were structured with a conditional timeline. Confirmation required within 48 hours of the next access window. The pressure was procedural, not emotional. If capital was not allocated during the 7-minute interval, the opportunity would dissolve. He reviewed the proposal in silence. The acquisition was not reckless. It was well-constructed. Due diligence appeared thorough. Market timing seemed favorable. But compression had altered perspective. He did not examine projected gains first. He examined the architecture of urgency. Why did confirmation require synchronization with the access window? Why had negotiation schedules been accelerated to converge with a system designed to prevent acceleration? Because they had adapted. The door had created predictability. Predictability allowed others to design strategies that relied upon it. Authority over time was being used as leverage against itself. During executive sessions, he listened to layered arguments. Presenters avoided emotional persuasion. They presented structural logic, market necessity, competitive positioning. No one raised their voice. No one pressured directly. They had learned that overt urgency weakened their case. Instead, they presented inevitability. The building's financial health, they argued, positioned it uniquely to absorb the acquisition. Failing to act would signal stagnation. Investors expected expansion during recovery cycles. Competitors would eventually regain strength. He asked one question: if integration timelines extended beyond forecast, how would liquidity be insulated without additional capital injections? The response referenced contingency planning, secondary asset divestment, conservative leverage assumptions. He asked no further questions. Silence followed. In the weeks leading to the interval, media coverage intensified. The potential acquisition became public knowledge. Analysts speculated about leadership shifts within the target conglomerate. Industry conferences referenced the institution as the likely consolidator. Public anticipation creates psychological commitment before formal action. Inside the building, departments began preparing integration frameworks preemptively. Human resources outlined transition models. Legal teams drafted preliminary contracts. Public relations prepared announcement statements. Though capital had not yet been released, structural motion had begun. This was compression at its most refined form. The door remained closed. He modified his review schedule again. Instead of reducing meetings, he attended more. Not to participate, but to observe tempo changes in speech patterns. Increased use of future tense certainty. Casual references to when instead of if. Confidence had replaced caution. 48 hours before the interval, market indicators shifted subtly. Interest rate forecasts adjusted upward by fractional margins. Not dramatic enough to destabilize projections, but sufficient to alter long-term debt servicing costs. The shift was technical, almost invisible to headlines. Integration financing would become marginally more expensive. In isolation, the adjustment was manageable. Within compressed timelines, it carried amplified impact. He recalculated structural resilience under revised conditions. The margin of safety narrowed. On the morning of the access window, the building operated with restrained anticipation. No open celebration, but an undercurrent of momentum. The secured corridor felt heavier than the previous quarter. Not louder, heavier. Authentication proceeded as before. Biometric confirmation. Internal clock alignment. When the mechanism disengaged, he entered without hesitation. 7 minutes. First minute. Validation of liquidity buffers under revised interest projections. Second minute. Evaluation of integration financing risk under stress scenarios. Third minute. Cross-analysis of target conglomerates' hidden liabilities revealed in footnote disclosures rarely emphasized in summary reports. Fourth minute. Simulation of compounded exposure if broader market optimism reversed within 18 months. Fifth minute. Silent recognition that refusal would disrupt internal strategic architecture already in motion. Sixth minute. Recalibration of long-term capital positioning away from acquisition dependency. Seventh minute. System lock. He exited the room knowing compression had reached its limit. By afternoon, executive summaries were distributed. The acquisition was denied. Not postponed. Denied. Capital allocations were redirected toward decentralized infrastructure investments across smaller, less visible entities. No public announcement accompanied the decision. Legal teams were instructed to disengage from negotiations immediately. Reaction remained controlled. Disappointment circulated through quiet channels. Weeks of preparation dissolved without ceremony. External analysts expressed confusion when negotiations abruptly ceased. Competitors moved cautiously into the space, but financing costs deterred rapid consolidation. Inside the building, structural friction surfaced for the first time. Not outrage, not rebellion, distance. Executive members began holding preliminary strategy discussions without including him. Alternative capital pathways were explored that did not require access to the time-locked door. Shorter-term instruments, leveraged vehicles with flexible liquidity. They did not challenge the door directly. They began designing relevance around it. Authority that cannot be overridden can be bypassed. He recognized the shift immediately. Compression had transformed into fragmentation. If capital authority remained isolated while operational strategy diversified independently, structural coherence would deteriorate. The door's power was not in denial. It was in alignment. Now alignment was eroding. The next interval remained months away. During that time, the building would test the limits of distributed autonomy. And if fragmentation deepened, the next 7 minutes would carry consequences beyond allocation. Fragmentation does not announce itself through rupture. It advances through subtle redistribution of relevance. In the weeks following the denied acquisition, operational teams adjusted with visible composure. Alternative financing instruments were introduced. Short-duration capital channels were activated without reliance on the sealed chamber. Executive briefings continued with disciplined language. Performance remained stable. On the surface, nothing had broken. Beneath it, coherence had thinned. Previously, all strategic expansion converged toward a single decisive moment each quarter. The time-locked door created gravitational order. Debate accumulated toward it. Ambition slowed in anticipation of it. Even disagreement aligned around it. Now movement dispersed. Departments began optimizing for internal approval thresholds rather than structural timing. Capital requests were redesigned to fit liquidity pools not governed by the access window. Risk committees adjusted exposure limits to enable incremental expansions outside the primary reserve system. Each change appeared rational in isolation. Collectively, they diluted central authority. He observed without intervention. Reassertion through confrontation would confirm insecurity. The door did not require defense. It required context. Without context, it became an obstacle rather than an anchor. 3 months moved with quiet acceleration. External markets entered a phase of artificial optimism. Recovery metrics strengthened. Consumer indices rose beyond conservative projections. Financial commentary shifted from caution to competitive urgency. Institutions that had endured volatility were now expected to expand aggressively. Internal pressure returned, but in altered form. It was no longer directed toward a single acquisition. It was distributed across multiple moderate-scale expansions, renewable infrastructure partnerships, emerging technology incubations, cross-border asset consolidations, none individually large enough to require the full capacity of the sealed reserves, all collectively significant. The executive structure framed the diversification as agility, reduced dependency on singular decisions, enhanced responsiveness to opportunity. The time-locked door was referenced less frequently. He recalibrated his analysis. Instead of focusing solely on capital distribution, he began mapping authority flow. Which departments held final sign-off power on secondary liquidity? How many approvals now bypassed the quarterly window? What proportion of long-term exposure was migrating outside centralized timing? The data revealed a shift that few acknowledged openly. While the primary reserve remained intact, strategic identity was slowly decoupling from it. He did not interpret this as rebellion. It was adaptation. When a structure enforces restraint, surrounding elements evolve to reclaim movement. The risk was not external collapse. The risk was internal divergence. If dispersed strategies expanded during a period of artificial optimism and structural correction followed, Decentralized exposures would require reinforcement from the primary reserve. The time-locked door would become reactive rather than anticipatory. That inversion would compromise its purpose. 2 weeks before the next interval, early indicators of strain emerged. Commodity supply chains tightened unexpectedly due to geopolitical friction abroad. Energy price volatility resurfaced. Interest rate expectations shifted again, this time with sharper upward revision. The optimism cycle contracted abruptly. Several of the newly diversified partnerships required liquidity stabilization within short horizons. Nothing catastrophic, but synchronized strain across multiple secondary channels. Executive meetings intensified, not in volume, but in urgency masked as professionalism. Reports included revised risk assessments. Stress tests were updated with compressed timelines. The time-locked door regained mention, this time not as a catalyst for expansion, as reinforcement. He attended each session without commentary beyond clarifying questions. No criticism, no validation. He allowed the pattern to complete itself. 48 hours before access, projections indicated that without supplementary reserve support, at least 3 decentralized initiatives would require restructuring at unfavorable terms. Reputational stability would remain intact, but financial efficiency would erode. The building faced a quiet inflection. If the door released capital to stabilize dispersed strategies, authority would shift permanently. The reserve would become a safety net for decentralized ambition. Timing would serve reaction. If the door withheld support, certain expansions would contract sharply. Internal friction would escalate. Questions regarding rigidity would intensify. He prepared without visible strain. On the morning of the interval, the secured corridor felt different from prior cycles. Not heavy with anticipation, not compressed with expectation. It felt evaluative, as though the building itself waited to see which architecture would prevail. Authentication confirmed identity. Internal clock aligned. The mechanism disengaged. 7 minutes. First minute. Comprehensive audit of decentralized exposures and their interdependencies. Second minute. Simulation of liquidity reinforcement impact on future behavioral incentives within executive structure. Third minute. Recalibration of reserve allocation thresholds under rising rate environment. Fourth minute. Assessment of long-term authority coherence if support were granted unconditionally. Fifth minute. Identification of specific initiatives whose contraction would recalibrate internal tempo without destabilizing external perception. Sixth minute. Allocation of targeted liquidity to 2 initiatives with structural resilience. Deliberate omission of reinforcement to 1 high-visibility expansion. Seventh minute. System lock. He exited with measured pace. By afternoon, executive summaries were distributed. 2 decentralized initiatives received partial reinforcement sufficient to stabilize their trajectory. 1, prominently positioned in prior public statements, received none. Within days, that initiative entered accelerated restructuring. Public narrative framed the contraction as strategic refocusing. Analysts interpreted it as disciplined portfolio management amid tightening conditions. Inside the building, the effect was more precise. The unsupported initiative had been championed by the most vocal advocates of diversification. Its contraction recalibrated confidence in bypass strategies, not through reprimand, through consequence. Simultaneously, the supported initiatives reinforced the perception that the reserve did not operate through blanket refusal. It operated through structural calibration. Authority realigned. Executive sessions shifted in tone. Discussions regained temporal awareness. Proposals were no longer designed to circumvent the interval. They were structured with acknowledgement of it. The door's relevance was restored, but in altered dimension. It was no longer perceived merely as restraint. It was recognized as filtration. Months passed. Market conditions tightened further. Institutions that had expanded aggressively during artificial optimism faced refinancing pressure. Some required external bailouts. Others underwent silent asset liquidation. Inside the building, exposure remained contained. The decentralized initiatives that survived did so under recalibrated discipline. Future proposals incorporated stress tolerance beyond optimistic cycles. Short-term agility remained, but no longer detached from quarterly gravity. He continued his preparation cycles without variation. Office unchanged. Calendar blocks marked review. No public commentary. The imbalance that had defined the earlier chapters dissolved. Not because power shifted outward, because it consolidated inward. Authority over time had not been defended through confrontation or rhetoric. It had been re-established through selective reinforcement and deliberate omission. The time-locked door remained sealed for another quarter. It did not require recognition. It required alignment. The building resumed its precise operations. Conversations regained measured cadence. Committees debated within understood boundaries. Ambition persisted, but filtered through structural timing. No declaration marked the shift, yet those attentive to pattern recognized permanence. The door no longer represented a barrier. It represented inevitability. And inevitability, once internalized, removes the need for enforcement.